So here's the thing, everyone in Canada wants to own real estate. But unless you've got a spare $500,000 lying around, it's almost impossible to buy property in cities like Toronto or Vancouver. And even if you somehow manage to scrape together a down payment, you're still looking at high mortgage rates, closing costs, maintenance, and property taxes. But what if I told you there's a way to invest in real estate, the same apartment buildings, office spaces, and retail plazas you walk past every day, without ever needing to buy or manage a single property yourself? That's where REITs, or real estate investment trusts, come in. They let you invest in real estate like you would a stock. You buy shares, they pay you dividends, and you participate in property appreciation without having to deal with tenants, toilets, or termites. And in today's market, where real estate prices are through the roof, REITs are one of the smartest and most affordable ways to build exposure to real estate income and growth in Canada. So in this video, we're breaking down exactly how to invest in Canadian REITs, what they are, how they work, the best ones to look at, how to buy them, and what to watch out for before you invest a single dollar. Let's get into it. Why Canadian REITs make sense right now. Let's start with some context. The Canadian real estate market has been a wild ride for the past few years. We've seen housing prices skyrocket post-pandemic, followed by interest rate hikes that froze parts of the market. But here's the catch, the demand for property in Canada hasn't disappeared. Immigration levels are still high, supply remains limited, and rental demand is at record levels. According to CMHC, Canada needs about 3.5 million more homes by 2030 to restore affordability, and that's just not happening anytime soon. So if you think about it, the fundamentals for real estate are still strong. It's just that owning property directly has become ridiculously expensive. This is why Canadian REITs have quietly become one of the most accessible and efficient ways to invest in real estate. They own the properties, collect the rent, pay out dividends to shareholders, and handle all the management headaches. You simply buy units of the REIT and earn your share of the income. And the best part? Many REITs trade on the Toronto Stock Exchange, TSX, so you can invest in them through your regular brokerage account, even inside your TFSA or RRSP for tax advantages. What are REITs, really? Now, let's break this down. A real estate investment trust, REIT, is a company that owns and operates income-producing real estate. Think of it like a mutual fund, but for properties. Instead of pooling money to buy stocks or bonds, investors pool money to buy commercial or residential real estate. By law, REITs have to distribute at least 90% of their taxable income back to shareholders in the form of dividends. That's why they're loved by income investors. Those monthly or quarterly payouts can be incredibly consistent. For example, RioCan REIT owns shopping centres across Canada, including some of the biggest retail plazas. Canadian Apartment Properties REIT, CAPREIT, focuses on rental housing, apartments, townhomes, and manufactured home communities. SmartCentres REIT, they're the ones who own a lot of the shopping plazas anchored by Walmart. So when you invest in these REITs, you're literally becoming a fractional owner in income-generating properties across the country. And the cool thing? You can start with as little as $1 if you're using a fractional investing platform like Wealthsimple Trade. Insert CTA. White right pointing backhand index if you don't already have a brokerage account. Check out the link in the description to open one with Wealthsimple or Questrade. Both let you buy REITs on the TSX with low or zero commission. The main types of REITs in Canada. Not all REITs are built the same. Depending on your goals, you can pick REITs that match your risk tolerance and income preferences. Here's a quick breakdown. Residential REITs own apartment buildings, townhomes, and multifamily units. Example, CAPREIT, CAR.UN, and Killam Apartment REIT, KMP.UN. Retail REITs own shopping centres and retail plazas. Example, RioCan, REI.UN, and SmartCentres, SRU.UN. Industrial REITs, think warehouses and logistics hubs. Example, Granite REIT, GRT.UN, and Dream Industrial REIT, DIR.UN. Office REITs focus on commercial office buildings. Example, Allied Properties REIT, AP.UN. Healthcare REITs own hospitals, senior housing, and medical offices. Example, Northwest Healthcare REIT, NWH.UN. Diversified REITs mix of residential, industrial, and commercial properties. Example, Choice Properties, CHP.UN. Each category performs differently depending on economic cycles. For instance, industrial REITs performed well during the e-commerce boom, while office REITs struggled post-COVID due to remote work trends. How to analyze a REIT before you buy? This is where most investors get it wrong. They treat REITs like normal stocks. But you can't just look at the P/E ratio or EPS like you would with Tesla or Apple. Instead, you want to focus on funds from operations, FFO, and adjusted funds from operations, AFFO. Here's why. FFO equals net income plus depreciation plus amortization, gains on property sales. It's a better measure of how much cash a REIT actually generates. AFFO goes a step further by adjusting for maintenance costs and capital expenditures. When you divide the dividend by AFFO, you get the payout ratio, and ideally, you want that number below 90%. A high payout ratio means the REIT might not have enough left for growth or reinvestment. Also look at debt to EBITDA, occupancy rates, and average lease term. For example, RioCan's occupancy rate consistently stays above 97%, which signals strong tenant demand. Now, let's talk about some of the best Canadian REITs that investors are watching closely right now. Because not all REITs are created equal, some are built for growth, some for income, and others for stability. So depending on your strategy, certain REITs might fit better in your portfolio than others. Let's go through some of the top names on the TSX and what makes each one stand out. 1. RioCan REIT, REI.UN. Dividend yield, around 6%. Market cap, $6 billion. Focus, retail and mixed-use developments. RioCan is basically the OG of Canadian REITs. They own and manage over 180 properties across Canada, mostly retail plazas anchored by big brands like Walmart, Canadian Tire, and Winners. But what makes RioCan interesting lately is their shift toward mixed-use properties, meaning they're not just relying on retail anymore. They're developing residential rental units above retail spaces, especially in urban centers like Toronto and Ottawa. This diversification helps them reduce risk from e-commerce trends while tapping into the rental housing demand. Why investors like it? White heavy checkmark steady dividend income. White heavy checkmark high occupancy rate, around 97%. White heavy checkmark smart shift toward residential. White heavy checkmark strong urban presence. If you're looking for a balance between income and stability, RioCan's a solid pick. 2. Canadian Apartment Properties REIT, CAPREIT, CAR.UN. Dividend yield, 3%. Focus, residential rentals. CAPREIT is Canada's largest residential REIT, and arguably the one most investors think of when they hear Canadian REIT. They own over 65,000 residential units across the country, including apartments, townhouses, and manufactured home communities. Here's what makes them so compelling. Canada's rental demand is booming. Immigration, population growth, and limited housing supply are driving rents higher. CAPREIT directly benefits from that trend. Why investors like it? White heavy checkmark diversified across Canada. White heavy checkmark exposure to high-demand rental markets. White heavy checkmark historically consistent dividend. White heavy checkmark great inflation hedge. It's one of the most reliable long-term REITs for people who want to benefit from the housing shortage without actually buying property. 3. SmartCentres REIT, SRU.UN. Dividend yield, 8%. Focus, retail and mixed use. You know all those plazas with a Walmart in them? That's probably SmartCentres. They're one of the biggest retail landlords in Canada, but like RioCan, they've been diversifying into residential developments. Their smart living brand is building condos, apartments, and retirement communities on land they already own. So instead of relying only on retail rent, they're unlocking new value from their properties through redevelopment. Why investors like it? White heavy checkmark strong anchor tenants like Walmart. White heavy checkmark high dividend yield. White heavy checkmark smart long-term development pipeline. White heavy checkmark experienced management team. It's a great income-focused REIT for investors who don't mind a little bit of volatility. 4. Granite REIT, GRT.UN. Dividend yield, ~4.5%. Focus, industrial and logistics. This one's a hidden gem, no pun intended. Granite REIT specializes in industrial real estate, warehouses, distribution centers, and logistics hubs across North America and Europe. Fun fact, it actually originated from Magna International, the auto parts giant. So their early portfolio was heavily tied to industrial tenants in that space. But over time, they've diversified into e-commerce logistics and modern distribution hubs. And that's a massive growth area, think Amazon, Shopify, and FedEx distribution centers. Why investors like it? White heavy checkmark exposure to e-commerce growth. White heavy checkmark low vacancy rates. White heavy checkmark strong balance sheet. White heavy checkmark geographic diversification, Canada, US, and Europe. If you believe in the continued growth of online retail and logistics, Granite is a strong pick for the next decade. 5. Dream Industrial REIT, DIR.UN. Dividend yield, ~5.5%. Focus, industrial. Dream Industrial is another REIT benefiting from the e-commerce boom. They own properties across Canada, the US, and Europe, and their occupancy rates are consistently above 98%. They're also good at managing debt and have a modern, well-located portfolio. For investors looking for a mix of yield and long-term growth potential, Dream Industrial is a great complement to Granite. 6. Choice Properties REIT, CHP.UN. Dividend yield, ~5.5%. Focus, diversified, retail, industrial, residential. Choice Properties is part of the George Weston Limited family, the same group that owns Loblaw. That's right, when you shop at Superstore or Shoppers Drug Mart, there's a good chance Choice Properties owns the land underneath. Their portfolio is heavily anchored by grocery stores, which are incredibly resilient even in downturns. They've also been expanding into industrial and residential properties. Why investors like it? White heavy checkmark grocery anchored stability. White heavy checkmark strong parent company. White heavy checkmark reliable income stream. If you want a defensive REIT that pays consistent dividends, this one's worth watching. 7. Allied Properties REIT, AP.UN. Dividend yield, ~8%. Focus, office and urban workspaces. Now, let's be real, the office REIT sector has had a rough few years. Remote work hit it hard, and it's still recovering. But Allied Properties has a unique edge. They focus on creative office spaces in downtown cores, properties that attract tech and media companies rather than traditional corporate tenants. They also own some of the most desirable properties in Toronto, Montreal, and Vancouver. Why investors like it? White heavy checkmark quality real estate assets. White heavy checkmark deep urban portfolio. White heavy checkmark high potential upside if office demand rebounds. This one's for investors who believe the office sector will eventually stabilize and want to buy into that recovery early. White right pointing backhand index if you want to check live prices or start investing in any of these. I've linked Wealthsimple and Questrade below, both let you trade Canadian REITs commission-free. How to actually invest, step by step. Okay, let's make this practical. How do you actually buy REITs in Canada? Here's the step-by-step breakdown. Step 1. Choose your investing platform. You can invest in REITs using almost any Canadian brokerage, but the two most popular are Wealthsimple Trade, great for beginners. Commission-free trading, fractional shares, easy-to-use app. Questrade, more advanced platform. Low fees, powerful research tools, and great for active investors. Both allow you to hold rights inside your TFSA or RRSP, which is key to avoiding taxes on dividends. Insert CTA. White right pointing backhand index links in the description for both. You can get a cash bonus when you sign up and fund your account. Step 2. Fund your account. Decide how much you want to start with. You don't need thousands, you can start small. Even $100 to $500 is enough to begin building a REIT portfolio. Step 3. Pick your REITs or ETFs. If you want to build your own mix, choose individual REITs like RioCan or CAPREIT. If you prefer diversification, go with REIT ETFs like ZRE, BMO Equal Weight REIT Index ETF, XRE, iShares S&P or TSX Capped REIT Index ETF, VRE, Vanguard FTSE Canadian Capped REIT Index ETF. These ETFs hold baskets of Canadian REITs, spreading your risk while still giving you that steady income. Step 4. Buy shares. On your brokerage app, search for the ticker like REI.UN or ZRE.TO, enter how many shares you want and buy. That's it. Congratulations, you now own income-producing real estate in Canada. Step 5. Reinvest and track performance. The key with REITs is consistency. Reinvest dividends when possible, especially inside a TFSA or RRSP where the gains are tax-free. Over time, compounding those distributions can make a massive difference in your total returns.